Good afternoon, Wealth Our Way Nation. What is going on? It is your man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. I want to welcome each and every one of you to episode 62. How do I determine the difference between a good or bad life insurance company? Before we get started, I want to thank each and every one of you who are here with me live as I stream across the Wealth Our Way Facebook or YouTube platforms. I want to give a salute to every member of Wealth Our Way Nation who watches the recording of this program overnight, over the weekend, wherever you can squeeze 15 minutes of financial literacy in. And our heartfelt, how are you? What's good? What's going on to the Life 101 platform members who listen to the audio of this here recording. With that being said, I told you yesterday, it is Life Insurance Awareness Month. And all week, we're going to be talking to all things life insurance, a little bit of information, not too deep, because the webinar coming up in October on the anniversary of the launch of Wealth Our Way is going to be all things life insurance. So we're going to get deep in that 3-day webinar about life insurance. So today, I'm just going to give you some 30,000 feet, views of what we should talk about on the insurance industry. We're going to do that all week because it is Life Insurance Awareness Month. Yesterday, I received a great question regarding how do we know what a good life insurance company is? And once again, I always need to remind myself that I have certain industry experience that other people do not have, based on what I've been doing for the last quarter of a century. So I tend not to worry too much about different insurance companies, the viability of them paying their claims, because I know a little bit about the process. But today, I'm going to share that information with you. And then I'm also going to, if time permits, get into how you should determine how much life insurance is good for you. That may run into tomorrow's broadcast. But what I'm going to do is share my screen with you guys today so that we can go over some information that I found in a Forbes article that I think is very helpful on this topic. So let's go. What happens if your insurance company goes out of business? When we're talking about a good insurance company versus a bad insurance company, one of the biggest things that we need to concern ourselves with is, are they going to pay? I don't think there's anything that's more important than knowing that if you've given someone premium payment after premium payment, that they are actually going to do what they told you they were going to do, which is keep their promise to pay your loved ones the death benefit in the event of your passing. So that's the first thing we want to worry about. There's more to it than just getting paid, however. Getting paid in a timely fashion for a lot of people is equally as important as getting paid. If you have expenses that are coming up very quickly, like funerals, like settling the estate with debts that are outstanding that your loved one or that you leave, you want to make sure that this money comes in a timely fashion. So it's not just about will the money come, it's also when the money will come. And some companies do a better job than others in terms of providing a expeditious delivery of claim. And then we also want the customer service experience to be one that is enjoyable. Nothing worse than calling into a company because you have a question, they got your money, you want to ask them something, you can't get a human being on the phone, or they pass you around, or they have rude people. You don't want that to happen either. I would think the primary concern, though, is, am I going to get paid? Is my loved one going to receive the death benefit that was promised to me when I started paying these premiums? With that being the case, I want to look at this Forbes article, which talks about what happens when your insurance company goes out of business. That would be the only circumstance under which your insurance claim would not get paid, is if the company, let me take that back. If you've done everything you're supposed to do, you didn't falsify any information, you didn't fail to make your premium payments, if you kept your end of the bargain of the contract, the only time you wouldn't get paid is if the insurance company had been determined to be insolvent or bankrupt, went out of business. But fortunately, the insurance companies have insurance. Every insurance is regulated by a state insurance agency. So there are 50 independent state regulations, as well as Puerto Rico and the District of Columbia. I'm sorry, Puerto Rico, and what's the other one? Give me a second. I have to sometimes remind myself of these bits of information. It's Puerto Rico, and it is, District of Columbia. I'm sorry. So the reality is that when you have an insurance regulation institution behind an insurance company, they make sure that the insurance company is doing what they promised to do. Unfortunately, insurance companies do go out of business. I know everybody is familiar with what happened in 2008 when some insurance companies took huge bets on collateral-backed mortgage obligations. And as a result, they put themselves in a situation where they couldn't meet their obligations. In that instance, one of the biggest insurers in the world, AIG, was on the brink of bankruptcy, and the government bailed them out, the federal government. But for smaller insurance concerns, they have to go and be backed by different state funds, these insurance guarantee associations. And this is basically a national organization that oversees the individual states and how they back the insurance companies. So what does this mean and why is it important? First things first, there's two things we should worry about when we're getting insurance from somebody. Are we getting insurance with a straight death benefit, where our concern is I pay a premium, something happens to me, I want a loved one to get a check? Or are we buying some form of cash value life insurance where we want our premiums to be divided amongst insurance and some savings account, and that savings account we expect to be credited with interest? I want to be very clear for the purposes of this 15 minutes of finance. I am solely today talking only about term insurance policies. Term insurance is a policy that you buy, you pay a premium in, something happens to you, a check gets written to your loved one. This is not about policies that actually grow cash value over time. That's a different set of concerns when it comes to good company versus bad company. I will address that. But for right now, I'm only addressing term. Why am I making that distinction? Because when it comes to term insurance and when it comes to policies that aren't very, very, very big. So by very big to me, I mean anything $300,000 and below. I will tell you, I don't care who your insurance company is. You could go to Bubba's Insurance Company and buy a term insurance policy. If you're going to go out and buy a $250,000 term insurance policy or a $100,000 20-year term insurance policy, you can buy it from your Uncle Jimmy's insurance company, as long as Uncle Jimmy's insurance company is a member of the state's guarantee association. Why do I say that? Why would I say something as callous as I don't care who you buy from? The reason being is your state guarantee association will guarantee any amount up to and including $300,000. So if Uncle Jimmy's insurance company goes out of business and you have a policy that you've been making your premium payments on, and it's a $250,000 term policy, and you should die while it's in insolvency, the state guarantee association will honor that payment on Uncle Jimmy's insurance company's behalf. Let me show you a list of what you can expect from different companies. Now, we're talking about life insurance today. So we're talking about $300,000 in life insurance death benefits. A lot of life insurance companies offer you long-term care insurance benefits as a part of your life insurance policy. So you want to make sure that those provisions are also covered. Everything else on here is not something that we're covering today. I'm concerning myself with whether or not my $250,000 term life insurance policy is going to be paid if my company goes bankrupt. So why would you buy from a company that you think has any close chance to going out of business? Well, it's a function of risk and reward. You take a risk with a lower level company. And the reward should be your premiums should be lower. When you go with the best, like I worked at New York Life for several years. This is not a plug for New York Life. In fact, I won't just single New York Life out. When I worked at New York Life, I believed, and I still do, that the four best insurance companies, the four most highly rated, as well as the four best funded companies were New York Life, Mass Mutual, Northwestern Mutual, and Guardian. These companies all have a huge track record of paying dividends. They are all well capitalized, and they have the top ratings offered by the ratings companies. And we'll get to the rating companies in a minute. If I was buying a policy that I am putting money into and I want cash value to accumulate, I would only buy from a company like those four. There are four more or five more on the list that I would also buy from, but it would have to be a mutual company or a company that, as a stock company, that has a high history of always prioritizing customer dividends above their stockholder dividends. With that being said, we're not talking about cash value policies today. We're talking straight term. Straight term, I wouldn't necessarily run out and buy from the top four companies. Why? Because they're going to cost me more money to buy a product that does the exact same thing for me that a lower level company's product would do. And when I say that, I'm talking about just providing the straight insurance benefit. Insurance has many features. Insurance can be converted. You can have a term policy that you want to convert to a permanent policy. Now you're talking a whole different monster. A permanent policy, I'm only going to get it from a company that has a history of paying good dividends. So if I know when I buy my term policy that I'm doing insurance planning and my goal is to get a permanent policy one day, I would buy my term policy from a higher rated company. I keep mentioning ratings, so let's talk about ratings. Here are the companies that rate insurance carriers: AM Best, Fitch, Kroll Bond Rating Agency, Moody's, Standard & Poor's. And you can see their ratings. The ratings on the left are their highest ratings. Over to the right are their lowest ratings. You get the ability to look at a company and see what their finances are, what their rating is, what other things should you be concerned about. I'm going to stop the screen share right now and go back to my happy face. What other things should I be concerned about other than just the rating? You want to make sure they have solvency. So when I was at New York Life, we used to brag to people that they had reserves. At the time I was there, it was like $21 billion, which meant everybody who had a New York Life policy could drop dead. Everybody who had an investment account with them could pull their money out, and they still had $21 billion left. That's a company I feel pretty comfortable being with. They're not the only company that has those types of stats, but that was the one I was at, so I have a lot more internal knowledge. What I do now, I don't sell insurance any longer. I refer people to brokers as opposed to agents. Tomorrow, I'm going to talk about the difference between an insurance agent and an insurance broker. But just to give you a quick high level of what they are, an agent works for a specific company. So I was a New York Life insurance agent. A broker can go out and find you insurance from any number of companies that they're appointed with, which gives you a better opportunity to compare one company to another. You still have to worry about how the person selling the insurance is compensated and what incentivizes them to pick one company over another. That's why you should always use an independent financial planner, plug, because you never know why someone is telling you something should be utilized. So with that being said, wanted to cover how you pick a good insurance company, ratings, capitalization, customer reviews to make sure their customer service doesn't suck. Ask them what their process is for paying claims, and then always check a third-party source like Wealth Our Way to give you the goods on an insurance analysis, which we do for all customers, as we also have it in a consultation basis as well. So I'm looking forward to seeing you guys tomorrow to continue this conversation on life insurance. Remember, our belief here at Wealth Our Way is wealth is not only for the wealthy. Have a great day, and I will